Well, the good part is that the market is not ready to give up on its gains just yet. The Nifty is still at the high point, up about 170 points. And lots of stocks. Mahanagar Gas is still your big mover, up almost about 7% And a couple of others. Star Health is seeing good traction. Samvardhan Motherson. Gale is in the green. Actually, PSUs are continue their up move after what you saw last week. And some of the paint companies like Kansai and Nerolac also doing pretty well. But diagnostics is the sector on our radar at the moment. You have, a couple of brokerages that have come out with reports. UBS Securities says that price increases and discount moderation is likely to improve margins for the sector, while BNP Paribas says that it is positive on the volume growth with recovery for the sector. To discuss more on the sector with respect to pricing, the outlook post-COVID, we have two gentlemen joining in. First up, Ravindra Kumar, who's the Chief Executive Officer at Lupin Diagnostics. And then we have Prakash Agarwal, the Deputy Head Research Executive Director Pharma at Axis Capital, who's been tracking the space for a really long time. Gentlemen, morning to both of you. Ravindra, let me start with you.
Good morning.
Can you tell us what is the current pricing situation? Have things improved? Because for a major part of the last year, there was a lot of pricing pressure. There's high competition. The space was going through a bit of a crunch in terms of earnings. Is the worst over?
So, to be very true, things has improved pretty well in a couple of months. What we are seeing right now, and there are different segment of player which are in retail as well as on digital side, and we are typically in the retail segment where we are doing pretty well, and the price is quite under control for last 6 to 8 months, and we are seeing it in right swings to move on.
Okay, so when you say things are improving, can you tell me particularly for the Lupin Diagnostics business, can you put the numbers in front of us? What is the revenue? What are the margins currently? And have you broken even in terms of, the EBITDA performance?
Yeah, so first of all, I would like to tell you that we are growing pretty well. We have now more than 400 plus outlets which are operating all across West and East India. And we recently launched our South India operation from Hyderabad, and we are on track in terms of driving the network reach in tier 2 and tier 3 cities market. And as you know, we do not break our numbers. So for all the numbers detail, probably you'll have to see our yearly outcome which comes in the month of June. But at a business level, we are right now in more than 125 plus cities. We are driving footfalls, and the great part is that as we committed that in India, there are more than 1 lakh plus labs, but hardly 2.8% are NABL accredited. We are pretty much confident, and we are driving the NABL accreditations pretty fast. Within 15 months of our time, we have 2 labs, Nasik and Pune, which are NABL accredited, and another 4 are in pipeline. I'm sure you know that in India, more than 70% of decisions in terms of treatment are based on diagnostics report. And it's very critical for any organization to drive quality services to the consumer so that a right line of treatment can be given to patients. In that,
all right. Pretty well. Got that, Mr. Kumar. But a couple of aspects, that our viewers and various shareholders as well would like to know. One is, you can't give us exact numbers, but are you profitable? Have you broken even? Point number one. And point number two, since you were talking about reach, what are the total number of touch points you have? And where do you see that number headed, say by the next couple of years or 2025 on?
Okay. So as I told you, we are right now just a 1-year-old organization. We started our operation in December 2021. In terms of top line, we are growing very fast and probably one of the fastest in the industry. And for rest of the details, definitely you can cross-check our financials, which will come in the month of May, June. In terms of network reach, which you asked, we are right now in more than 125 plus cities we are operating, and we have 24 plus labs. We are right now have more than 400 plus collection centers and close to 2,000 plus touch points in terms of pickup points which we are serving right now.
Sure.
So this is in terms of network.
Okay, got that. Ravindra, just stay on. We'll come to you in a bit. We also have Prakash Agarwal, who has been tracking this space very closely. Prakash, the big theme last year, right, in the last 1 year has been heavy discounting that the diagnostics companies have had to give in order to compete with sort of newer participants, new entrants. Is the worst of the discounting behind us? And how is the situation on the ground currently?
So we had a fairly good amount of channel checks, talking to a lot of online players as well as new age players who are backed by PE players. So what we see on the street is while the discounts remain very high, I mean, they range at 40 to 75% from the rack rates which the large diagnostic companies are offering. At the margin, the discounts are coming down, but that is only at the margin. So even after the discounts coming down, the prices are still 40 to 75% lower. So we are seeing that some of the patients, wellness consumers are shifting from the traditional diagnostic companies to these new age diagnostic companies, largely on the wellness side and as well as on the chronic illness side. So that's 60% of the market. We do see that there is pricing pressure in the industry. And if
Yes.
you compare just the last 5-year data of the large diagnostic players, their prices have remained largely constant. So that
Okay.
really, yeah.
Yeah. All right, Prakash, clearly you're making your case for derating of the sector and some of these diagnostic companies as well. So give us a couple of numbers then. What is the multiple that it normally used to trade at, some of these diagnostic stocks? You believe it should be lower, I understand. So how much lower? And also as a brokerage house, how much lower are your estimates in comparison to what consensus is at?
So we are about 15 to 20% lower than the consensus numbers even today. We believe that while growth can come back, given unorganized to organized is still a very large shift that is happening. But we are a little negative on the margin side. We believe that the costs have gone up, cost of doing business has gone up, A. B, all the companies are expanding. So there is a threshold cost of setting up as well as bringing it to break even. So that cost is there. Plus raw material prices also have increased. So on the gross margin side, there's an impact. EBITDA margin, there is an impact. Plus all these large companies have also acquired large, assets like, for example, Dr. Lal has bought Suburban as well as Metropolis bought High-Tech. So these also have some higher interest costs and amortization, so which leads to lower PAT margin and lower ROEs. So what you'll probably see, the ROEs which were 25-30% has come down to 15 to 20%. So there's a lot of derating already happened, but we see that it will remain stagnant. While the can come back, but margins will be lower is what I wanted to highlight.
Okay, just one final question from my end. Since you spoke about Dr. Lal's, the stock has lost 30% of its value, right, from the highs. It was at one point at around that 2,700 level. Do you think there's anything that any trigger that could sort of take the stock back to those levels, or are you still cautious despite the fall that we've seen?
Yeah, no, so you are right. And we also highlighted in our report from a peak of 60 times plus, the multiples have gone down to around 40-45 times. So a large part of this COVID wave had come and the street had extrapolated that. So that has come off clearly. We are seeing some headwinds currently by these online players, which is keeping the volume restricted. Yes, there are small green shoots available currently. Dr. Lal per se, as per channel checks, have taken some price hikes in select, a diagnostic test menu. But these are, I think, very small steps. Need to do something larger in terms of geographical footprint, some rationalization of prices to have a higher volume growth. India is largely a volume growth country, so we need to, have a fine balance between growth and margins, and that's what will keep the clock ticking, I guess.
Okay, all right, gentlemen. We will leave it on that note for today. Good to get your perspective on the way the diagnostics sector is really shaping up and the important triggers that lie ahead. Well, with that, we will move to our next corporate conversation. And we are going to be speaking with the management of Lemon Tree Hotels. That's the next company on our radar. Now, Lemon Tree has recently signed several new license agreements. We'll talk about, of course, their expansion plans, the outlook for FY24 and more. We have Mr. Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels, joining in for that. Mr. Keswani, thank you for joining in. Personally, I can tell you I'm really looking forward to the Kasauli property and the one in Manali in Himachal Pradesh. I think those are the new keys that you're adding. But before we talk about the expansion and really sort of, how it adds overall volumes, tell us about occupancy levels. Has the fourth quarter been as good as Q3 or even better I think you had indicated that you could be at around, what, 75% occupancy. Are you there or even higher than that?
Well, we have two portfolios. One is the Keys portfolio and one is the Lemon Tree Hotels portfolio. So Lemon Tree is definitely above 75. Keys is a little, well, not little, significantly under that. So on a weighted average basis, we are around 75. About this, our last 2 quarters, you asked me. Basically, we've been repricing. So every quarter, we have tried to reprice our hotels. So occupancy in Q3 wasn't as good as I would have liked. It was about 68, 69%. But from this quarter, it will stabilize now at about 75. So we will get both the price upside and the occupancy upside this quarter.
Okay, all right. Hi, Mr. Keswani. My colleague Surbhi is looking forward to some of those new outlets that you're opening up, but it definitely will come at a cost, right? And you said in the past that, 2007, 2008, the average room rent as well was 8,000 plus, and you expect it to move in that direction. So where do you see the average room rent stabilize, let's say, in the coming year, in the coming month? And what is it at currently?
So for Lemon Tree, it is over 6,000, but Lemon Tree itself is an average of Red Fox, Lemon Tree, and Lemon Tree Premier and Aureka. So if I break it down roughly, Keys is at about 3,500. Red Fox is about 4,500. Lemon Tree is about 5,500. And then the Lemon Tree Premiers are obviously about 8,000. And Aureka is about 16,000, 17,000. So you hear, when we talk ARR, it's a blend. But to answer Surbhi's question, Kasauli itself will take some time to open because these are all hotels under development. But it will be an Aureka, and by then, I think hotel prices by next year will be much, much higher than what you see today. See, keep in mind.
I thought you would say much lower. I thought you would give us some good news. I mean, much higher than what they are currently.
I'm happy I'm traveling at the end of this week.
Yeah. There go our plans.
I want to correct you, folks. Nobody in their right mind will build a hotel today at current prices. It makes no sense. So what you have to really look at is the cost to construct rather than the rates that I think everybody has gotten used to in the last few years.
Okay. So the repricing will keep happening. Okay, I mean, jokes aside, Mr. Keswani, you did mention that in Q4 you will have the upside of more volumes as well as the repricing. Can you give us some more sense? How much more repricing will we keep on seeing? And are you confident that it will not start crimping demand at some point?
See, demand has been growing on an aggregate basis, north of 10% every year for the last, nearly 2 decades. So it's not a question of demand. It's a question of pricing to capture the right amount of demand. So if demand is growing at 10% and now supply going forward will grow at 5%, then obviously there will be price hikes such that you can fill your hotel and a whole bunch of people will shift down. So people who were staying in 5 stars may stay in 4 stars, 4 stars may stay in 3 stars. But the fact is that the increase in pricing is nearly certain. Not nearly, I would say it is certain. And it will continue, in my opinion, for the next 4 years.
So I just want to understand what's really happening in this whole rooms and accommodation business, not just in terms of hotels, but also homestays, right? I mean, a year and a half ago, that was the big sort of blowout industry, homestays, saffron stays of the world. Now, since the hotel industry has opened up again, has there been a cool-off over there? And what do you think would be the next big trend in the hospitality space?
Well, I'm not a soothsayer, Sonia, but, during COVID, a lot of people wanted to, A, go out, so it was drivable distance, and B, take just take a break. So in that sense, homestays made a lot of, had a lot of demand. Going forward, I think it will be a segment of the transient accommodation business. It will grow. I have a feeling that, homestays are an exciting opportunity, providing you can manage very fragmented scale. So, you have small, villas or equivalents all over the place. How do you manage the logistics is something I myself haven't gotten around, but it's an exciting segment. I myself would happily go and stay in such a place as a break away from the traditional hotel resort.
All right, Mr. Keswani, final question then before we let you go. Earlier we were talking about 800 crores of revenues in FY23. You're well on course and you're definitely going to be, go by the numerically, you'll definitely cross that number. For FY24, given the higher occupancies, better rates per room as well, what's the growth in terms of revenue and the rough margin trajectory?
Well, I've said in my last call to analysts that we will be at least 20% over this year's revenue, and our net EBITDA margin will be north of 50%. So you just take the numbers, we'll be over 1,000 crores and definitely over 500 crores in EBITDA.
Okay, and you've said in the past, that the net debt number is not a worry, but where do you see this number stabilizing at? It's only around 1,700 crores. So, what's the outlook out here?
Well, the net debt will not materially change. We're opening this big hotel in Bombay. In fact, the biggest hotel in India. It's nearly 700 rooms. We opened that in October, and that will open with internal accruals. And that hotel itself has the capacity to give us 200 plus crores of EBITDA. And
by when is that? By when will that come in?
October this year, in 7 months.
So you're looking at the 200 crore plus EBITDA by FY24, I assume?
No, it will be FY25. In FY24, we will open it.
Okay. All right. Okay, we will leave it at that. All the best. This is a dream run for the hotel and hospitality industry, and I hope it continues that way. It's been a long lull for a while. That is Lemon Tree Hotels. The stock is actually up 3.5%, but let's get back to Mitesh Thakkar now to give us a quick view on what's happening at 10 a.m. Looking good, Mitesh, almost 172 points higher now for the Nifty. Is this a juncture at which you expect this run to continue, or do you think the markets could consolidate here? Your thoughts on individual stocks as well?
See, my feeling is that some profit booking will happen in this range of 17,750, 17,800 zones, and therefore, I think, we have taken marginal profits over there. But overall, I think this looks like a market with the kind of strength it's showing that it will continue and possibly do very well. So I think we'll revise the targets towards 79.70 on the upside. But yeah, take some profits and see if you get an intraday dip, because you have had a very good rally on Friday as well. So I think that's the way we are approaching it.
Okay, all right, Mitesh, thanks for the calls. Before we let you go, just quick check on the picks as well.
Yeah. So Nalco is a buy with a stop at 82 for targets of 90, and M&M Finance is a buy. Keep a stop just below levels of 250 and look for targets of 270.
Welcome back. Well, it's been a solid start for equities. Let's find out how the morning is looking for the commodity markets. Manisha is back with us. Manisha, what do you have your eye on?
I'm looking at the metal prices, Surabhi, because last week was such a great one. We have nearly 2 to 4.5% of gains coming in across metal prices. But that hasn't been the case today morning, because you've seen a bit of a profit taking coming in. And this is on reaction after the China held its annual meeting of the National Party Congress on Sunday. And China has set economic targets from 2026 to 2030. That is what they do. They set targets for the next 5 years. And the markets were anticipating stronger allocations, funding and growth numbers as well. And that's exactly what we did not see. So while 2022 saw a growth of 3%, markets were anticipating 6 or at least 5.5% on the higher side. China has set a weaker than expected GDP target at 5%. And that has led to some pressure coming in for many of these metal prices. Last year, as I said, last week rather, we did see stronger gains. China also is looking at inflation and the trade data numbers coming into this week. So it is going to be an eventful, choppy week going forward into this one. But as I said, last week we saw strong gains because the PMI numbers from China came in stronger. The US dollar index had seen some profit taking. And then the markets also saw jobs data come in from the US markets on a tepid note. All of that was very supportive. And is the reason you saw 2% of gains come in for gold, 3.5%, nearly 3% for silver, and 2 to 3.5% of gains come in for copper, aluminum, and zinc. But we have started Asia or the week on a weaker note right now. Also, when you look ahead, there's just so much data coming in for this week. As I said, one is the China trade and the inflation numbers. Today, you have the US factory orders coming in. Tomorrow, it's going to be the Fed Chair, Jerome Powell, testifying as well. And that testimonies will continue on to the Wednesday as well. Apart from that, it is the Australia rate decision that also comes in on Tuesday. Not just Australia, you have Canada and ECB important testimonies also coming in. Wednesday is going to be the ADP non-farm employment numbers. And as I said, the Jerome Powell testimony continues for a second straight day on Wednesday as well. Thursday is going to be the US jobless numbers. And Friday is going to be the US non-farm payroll data. That's going to be equally important for the markets to take direction from.
Okay, so many rate-setting meetings, right, from across the globe, whether it's the Reserve Bank of Australia, the Bank of Canada, the Bank of Japan. It's a heavy week of data. Thanks a lot for joining in, Manisha. Well, the other stock that we're looking at this morning is Nykaa. There's an interesting report, a cautious report actually coming in on Nykaa this morning. Mangalam is here to take us through that. Mangalam.
Interesting to see a cautious report coming in on Nykaa after a near 70% correction from the top on the stock itself. Macquarie has initiated coverage with an underperform rating and a target of 115 odd rupees. They say that the company's beauty business faces risk to margins as growth moves to smaller towns, also growth moves offline, and the competition threat is real. And the other business that they have, which is the fashion business, out there, Macquarie says that their experience from physical retail makes them cautious on the company's own brand focus and curation-led positioning in that vertical itself. With the company's limited operational history plus need for growth investments, makes them cautious on their EPS growth as well, as a result of which the stock lower on their underperform rating.
Okay, yes, it's recovered a bit from the opening gap down, but still down about 1.5%, just under 1.5%. Thanks, Mangalam, for that. Well, the other stock that's moving in the opposite directions, really soaring away, is MGL, Mahanagar Gas, and that's because of an acquisition that they've done. Sonal's back with us. Sonal, do give us more details and color and why the market's so excited about this.
Well, a couple of reasons here. The first thing is that it's the first ever acquisition that the company has made, and it paves way for volume growth going ahead and more expansion plans as well for the company. To give you the news, they have acquired Unison Enviro Private Limited for 531 crore rupees. This is an all-cash deal, and it is a city gas arm of Ashoka Buildcon. This gives them more access to other geographical areas as well, and that is the reason the company has actually acquired it. It has right to 3 geographical areas, which comprises of Ratnagiri, Chitradurga, Devangre, Latur and Osmanabad districts as well. In terms of turnover, FY22 turnover for Unison was 89.5 crore rupees, but they made a loss of 25 crore rupees. But going forward, the volume growth prospects are strong, and that is what analysts are very bullish about as well. ICICI Securities says that some industrial and commercial potential in each of the districts for the geographical areas where Unison is would give volumes of around 0.2 to 0.25 MMSCMD in next 3 to 4 years. This would mean this would add volumes of 1 MMSCMD to Mahanagar's portfolio by FY28. They have a buy rating with target price of 1125 rupees per share. Citi says this is the first inorganic foray, so while it is expensive, 6.5 times trailing price to book, it would view the acquisition positively because there was a lot of the analysts were cautious about the volume growth prospects of Mahanagar, and that takes it away. It could change perception around MGL's perceived lack of growth aggression and would be a good use of cash as well. So analysts are bullish about this acquisition, and that's why the stock is higher in trade.